Ray Dalio is said to be one of the best macro investors in the world, and recently he filed his 13F, which gives us, the public, an insight into what he is buying and selling in the Bridgewater portfolio. In today's video, I want to go through Ray Dalios' portfolio and show you all what he is buying and selling, and give you my opinion on why he might be buying and selling these positions in specific. With that being said, let's just hop right into the video, and I want to show you all right here what Ray Dalio is buying. Right away, we can see if we just scroll down, these are Bridgewater's top 50 positions. And number one is Procter and Gamble, then Johnson & Johnson, an emerging market ETF, the SPY index, and then Coca-Cola. And further down here, we can see that Ray Dalio is also trimming down another emerging market ETF, Pepsi, and then down here, he is also trimming McDonald's. Now, I want to show you all why I think that he is trimming down his strong American brands. So we're going to head over to Stock Unlock here very quickly, and I'm just going to input Procter and Gamble, Johnson & Johnson, Coca-Cola, Pepsi, and lastly, we are going to input McDonald's here. Now, what we're going to do is we're going to take a look at these 5 companies' price to free cash flows in our freeform tool here. And right away, we can see that Johnson & Johnson is trading for a price to free cash flow of 22, Coca-Cola is 27, McDonald's is 32, Pepsi is 39, and Procter & Gamble is about 26.3. What I am noticing here is that these are quite expensive price ratios for these businesses. These are businesses that are not growing very quickly at all, and they're selling for price ratios around 30. The only one that is not selling for a price to free cash flow of around 30 is Johnson & Johnson. If we also scroll down here to Stock Unlock Quick Stats, we can see that the average price to free cash flows for these businesses are well below where they are currently trading. For example, Pepsi's average price to free cash flow over the past decade has been about 25, and now it is selling for a price to free cash flow of about 39. So it is selling way above its historical averages. Now also, if we scroll back up here and we take a look at the revenue growth of all of these businesses over the past decade and scroll down, we can see that Procter & Gamble has actually not grown its revenue over the past decade. Johnson & Johnson has grown at about 4% annually. Coca-Cola has not grown revenue over the past decade. McDonald's has not grown revenue, and Pepsi has grown at 2%. When you take a look at the revenue growth of these businesses, and then you think, well, these businesses have price to free cash flows of around 30 right now, while they're not really growing revenue, it tells me that they are starting to look very expensive. And here on my channel, I have been saying that these stocks have been looking expensive for quite some time. So let's also take a look at the free cash flow growth of these 5 businesses. And this is a little bit of a different story. Procter & Gamble has grown free cash flow at about 4% annually, Johnson & Johnson about 6%, Coca-Cola about 4.5%, and then Pepsi and McDonald's is about 3%. So all of these businesses over the past decade have managed to grow their free cash flows, but it's still not at a very fast rate. I just don't think that these rates or these growth rates to free cash flow can really justify price to free cash flows of like 30. It really looks to me like these businesses have been becoming more and more expensive, especially over the past couple of years. Why I think that these businesses have become more expensive over the past couple of years is because inflation is really high. Inflation is at a 40-year high right now, and Warren Buffett has said that the best thing to own during high inflationary periods is businesses with strong brands, like Coca-Cola, like Pepsi, like McDonald's, like Johnson & Johnson, and like Procter and Gamble. So what I think has happened over the past couple of years is investors are buying these positions or buying these stocks massively because they're seen as strong inflation hedges. This has led to these stocks rallying like crazy, and ultimately these stocks are now looking very expensive relative to their underlying fundamental growth. So now let's head back over to Ray Dalios' portfolio right here, and it does make sense to me why he may be wanting to trim down these positions, because they are getting quite expensive in my own opinion. Now, what's also interesting though is that Ray has increased his position in Costco and Walmart. So if we head over here to Stock Unlock and we take a look at Walmart and we zoom in on the stock chart, we can see that Walmart had this massive correction in the second quarter. The stock price fell by about 25%. So in the second quarter of 2022, Walmart saw that 25% correction. Now, if we also head over here to Costco, Costco's stock had similar price action. Here in April of 2022, it was selling for about $603 a share. And then in the second quarter of 2022, it fell by 31% all the way down to about $416 a share. So both Walmart and Costco saw corrections of about 25 to 30% in the second quarter, and it looks like Ray Dalio used this as an opportunity to increase his position in these businesses. So right here, we can see that both Walmart and Costco's free cash flows are absolutely, Walmart's free cash flow is absolutely tanking. It was about $26 billion in the first quarter of 2021 in the trailing 12 months. Now it is sitting at about 5.4 billion. So Walmart's free cash flow has fallen by around 70 to 80% over the past year. And this is because Walmart and Costco have massive increases to inventory costs right now, and it's eating away at their free cash flow. And this is also due to inflationary pressures. They're seeing a little bit of an oversupply. This is harming margins. It's harming their free cash flow margin. It's making the free cash flow drop, and it's making the stock prices drop. And it looks like Ray Dalio is taking advantage of this and buying the dip on these businesses, because over the long term, I do think that their margins and their profitability is going to come back. And yeah, to me, again, it just looks like Ray Dalio is taking advantage of the dip on Costco and Walmart. Let's head back over to Ray Dalio's portfolio. Let's take a look at the largest percent gains. So the positions that he's adding the most to in terms of percent changes. And what's interesting about this is the top positions are Meta, Google, MasterCard, PayPal, and then ConocoPhillips. These top four positions right here that he's adding to are all tech stocks. And this is interesting because think about it. He's selling off your typical value stocks like Pepsi and Coca-Cola, and he's adding to the more tech stocks and the more growth stocks like Meta, Google, MasterCard, and PayPal. Let's head back over to the freeform tool once again. Let's take a look at Meta. Let's add in Google, and let's add in MasterCard here. Now, what I want to do is take a look at these businesses, and really what I want to take a look at is their price to operating cash flows right now, because Meta is sitting at a price to operating cash flow of only 7.7. MasterCard is sitting at a higher price to operating cash flow of about 34, but Google is sitting at a price to operating cash flow of about 16. If we take a look at Google and Meta specifically, these businesses are trading at price to operating cash flows well below the typical value stocks, again, like Coca-Cola and Pepsi. Google is selling for about half the price to operating cash flow as Pepsi right now. And I think that this is super interesting because if we take a look at the revenue growth of these businesses and we scroll down, we can see that Meta has grown revenue over the past decade at a compounded annual growth rate of 40%, Google is 20%, and MasterCard is about 11.6%. If we even zoom into the past 5 years, Meta is about 32%, Google 24%, and MasterCard about 14% if we want to round up. These businesses are now trading for price ratios at or well below the typical value stocks, and they are growing much, much more rapidly. So what I am seeing in the market, and what I've been saying here on my channel for quite some time, is that the value stocks are starting to look expensive, and your typical growth stocks are now starting to look cheap. If we even take a look at these businesses' free cash flow growth over the past 5 years, Meta is 22%, Google is about 19%, and MasterCard is about 19% compounded annually, again, over the past 5 years. These growth rates far outpace the other stocks, and now these stocks right here are trading for cheaper price ratios. Now, the last thing that I want to show you all is once again the price to operating cash flows, and I want to show you the historical averages, because Google's historical average price to operating cash flow over the past decade is about 17.65. It's now trading well below that. This is the same story with Meta, and MasterCard is the only one here that looks like it is trading above its historical averages. But these other two tech stocks, in my opinion, are looking quite cheap in the market right now. So it looks like Ray Dalio is kind of making a rotation out of your typical value stock and then buying the tech stocks, while the tech stocks have seen a massive correction over the past year and their price ratios have really compressed. If we head back over to Ray Dalio's portfolio, the next position here is ConocoPhillips, or COP. This is an oil company, and if we take a look at COP here, we can see that COP's price to operating cash flow is about 5.66 right now, which is quite low. If we also take a look at the price to free cash flow, this is a much more volatile metric for this company's history, but ConocoPhillips' price to free cash flow is only 8.6 right now. And this is very interesting to me because if we take a look at the company's free cash flow, it is absolutely skyrocketing. It is sitting at, is it sitting at an all-time high? Yeah, the trailing 12 months free cash flow for this business is sitting at a trailing 12 months all-time high right now. And if we take a look at the company's free cash flow yield, it's also sitting at about 11.7%. So if ConocoPhillips wanted to, take 100% of the free cash flow and pay that out as a dividend to shareholders, it could pay out about a 12% dividend yield right now on today's share price using organic cash flows, because oil prices are just skyrocketing, and that is allowing the business to see this massive growth to free cash flow. And it looks like Ray Dalio is increasing his position in this oil company to benefit from the high oil prices, which also may tell us that Ray Dalio thinks oil prices are going to remain high. This is kind of a cyclical sector. I mean, take a look at the free cash flow for this business once again. We can see that this is kind of a cyclical sector. I mean, you got high free cash flows in 2007. Then during the Great Recession, free cash flows went negative. They absolutely tanked. Then they came back in 2011. Then they fell back to 2015. Then they came back in 2018, fell in 2020, and now they are absolutely skyrocketing. So you can see that this is a cyclical sector. The oil sector is very cyclical. But even though that the free cash flows and oil prices are at an all-time high right now, again, Ray Dalio is happy to be buying these stocks and increasing his position. So maybe he thinks, again, that oil prices are going to remain high or maybe even go higher. Let me know what you think down in the comment section below. This is all of the top moves that Ray Dalio is making. And just to summarize, it looks like he is trimming or selling off his typical value brands like Coca-Cola, Pepsi, McDonald's, Procter and Gamble, and Johnson & Johnson. And now he is adding tech stocks like Google, Meta, PayPal, MasterCard, and he's even adding oil stocks. So let me know what you guys think down in the comment section below. And also, if you guys are interested in this platform here that I use on my channel, Stock Unlock, you can now get a 14-day free trial by clicking the link at the top of my description, and you guys can get access to this platform. It is absolutely amazing, and we are building out a portfolio feature right now where you will be able to track your portfolio, and it's going to be one of the best portfolio trackers on the internet. I seriously mean that, and we're building it out right now. It should be out hopefully within the next month or so. If you guys want that 14-day free trial to Stock Unlock, then click that link at the top of my description. And that's pretty much going to wrap up the video, everyone. So once again, let me know what you guys think about Ray Dalio's portfolio. And if you enjoyed this video, then please remember to leave a like on it. And if you're new here, then please consider subscribing to my channel if you want to stick around and see more stock market related content. But that's going to wrap up the video, everyone. So thank you again so much for watching. I truly do appreciate it. And I really hope to see you all again in my next video.